So today, basically, we are going to start with the introduction. You can see my screen as well, right?
Yes.
Okay, great. So basically, we are going to start with the first section. We're going to start with the first section. So this one is your study program, ne? This one is your study program.
Okay.
From 27 July to 31 July, start part 1, but mostly we are not going to follow it that much because we need to take into account a much quicker pace so that we can also have enough time for revisions after we are done with the content. Okay.
Okay.
So today we are going to cover chapter 1, why study money, banking, and financial markets. Okay, so at first what we are going to do, we are going to incorporate what we mean by money and also the meaning of these financial markets as well. Okay, so at first we are going to define what a financial market is. Okay, so basically, let me annotate it for you so that you can see as well where I am. Okay, so basically we are going to start with what is a financial market. Okay, so basically a financial market is a market in which people trade financial securities. So it's just like a market, but it's a different market now from the goods market or from the labor market, okay? It's a different market.
Yes.
Goods market, it's a different market from the forex market. It's also a different market from the labor market. So this is known as a financial market. So it's just like a market. It functions like a market, just like any kind of market you might think of, but it is where the buying and selling of financial securities and derivatives takes place. Okay. So the
Yes.
buying and selling of securities, the buying and selling of stocks, the buying and selling of bonds, the buying and selling of any financial instruments that you might think of takes place in what is known as a financial market. Okay. So basically, financial market, like what we have said, is a market in which people trade financial securities and derivatives at a low transaction cost. Okay. Some of the securities
Yes.
that are traded within the financial market, they include stocks, they include bonds, and they can also include precious metals. Okay, so we shall also take into account a stock market. We shall also take into account a bond market. Okay.
Yes.
So financial markets like bond and stock markets, in which we have highlighted before, financial markets such as bond and stock markets are crucial for promoting greater efficiency. So the emphasis of efficiency here is coming about because of the fact that we have funds that need to be channeled from where there is surplus financial or surplus funds to where there is deficit funds. Okay, and that is the responsibility of the bond and the stock market. So the financial market, such as the bond and stock market, are crucial for promoting greater efficiency by channeling funds from people who do not have a proper use to people who do. Okay, so what we mean here, we are saying that we have individuals that have surplus funds, okay, or surplus finances, right? And they do not have proper use of those funds, okay? And we also have other households that do not have the funds, but they have proper use of the funds. So there is now need for a stock and a bond market to come in between these two individuals so that it can channel the funds from those whom do not have the proper use of the funds to those who do have the proper use of the funds. Okay, so it's just like like it's acting like an intermediary between an agent whom have surplus funds and an agent whom have deficit funds. Okay, just like what a bank does, just like what a bank does, just like what FNB, what ABSA does. You go to ABSA, if you save 100,000 in your savings account, I can also go tomorrow and borrow maybe 80,000 rand, right? So it's now acting in between both of us, okay? Because specifically, I cannot just meet you in the street and say, I need to borrow 80,000 rand from you. But if I go to FNB, it's very legit now. I can do so. And you can also save your finances within the financial market, okay? So that is what we are referring to as economic efficiency now. That is what we are referring to as economic efficiency, okay?
Okay.
So well-functioning financial markets are a key to producing high economic growth and have direct effects on personal wealth, personal behavior, on business, consumers, and the cyclical performance of an economy. So basically, we are now saying that when the financial market as a whole is functioning well, it has a greater effect on the performance of the overall economy, okay? We shall also take into account a situation whereby we now have a financial crisis, okay? We shall also do that in this chapter. When we now have a financial crisis, within a financial crisis, we now have the financial market which have collapsed, okay? So basically, the functioning of the financial markets now in terms of economic efficiency will no longer be there. They will be now absent. So we are saying that at the end of the day, a well-functioning financial market, it also leads to economic growth. Okay, why economic growth? Because we also know that for the economy to grow, we also need some investment activities, right? We also need some investment activity. And for you to invest, at times you might need to borrow, okay? You might not have enough funds to build up a factory, to build up a plant, but you might do so through borrowing. So it's now standing in between those whom does not have proper use of funds with those whom does have proper use of funds, okay?
Yes.
Is it making sense?
I think, well, it sounds like it, but thing is, I'm trying to also like think of it practically when you're saying that.
Yes.
How did you say? That the economy, that the success of the economy depends on the, how efficient the markets operate.
Exactly. Okay, so in that manner, I've also given you an example of the fact that, let's say you want to invest, right? You want to invest, okay? Maybe that investment, we can put it in the form of gross capital formation, okay? You want to invest, you want to build a new factory or plant, okay? Any plant you might think of, maybe of steel, maybe of, you want to produce plastic, you want to produce rubber, or any product you might think of, okay? So we are saying that at some point in time, you might not have enough funds to do so, okay? You do not have enough funds to open a big factory that you might think of, okay? So here comes now the financial market, okay? Here comes the financial market, whereby you can now go and take a loan, okay? So if you take a loan, literally, it means that that bank or any financial or intermediary in which you have approached, it have facilitated you in that investment activity, because you were not going to take any investment activity without that loan that was extended to you. Okay, so that one is a practical example, and literally it happens economically, right? You go to FNB, you go to apps, and take a loan, and then you invest. Okay, so literally it means without FNB, without apps, you were not going to invest. And we also know that investment, it have a very direct relationship with the performance of an economy. An economy does not perform without investment. Okay, that's why most of the countries, they are much embedded in terms of investments. Okay, they want to promote investments as much as possible, because we know that if there are high levels of investments, at some point in time, you are able to produce more, because what we refer to as economic growth is just output. Okay, it's just aggregate output. If you are able to produce more, it also means that the economy overall have grown. And in that manner as well, to produce more, we need also to employ labor. Okay, so that's why most countries, they want to put in place various instruments, various tools, various policies, so that they can attract investments, just like foreign direct investment, just like portfolio investment. Okay, is it making sense now?
Yeah, it's making sense.
Okay, so let's take a look on the bond market. So we introduced a stock market. We also introduced a bond market. So we now want to take that into account. Okay, so basically, so we're going to start with so a financial instrument may be, so what we are now defining a financial instrument, right? A financial instrument may be the evidence of ownership of part of something, as in stocks and shares. Okay, bonds that we are referring to, which are contractual rights. So a bond is a contractual right to receive cash. Okay, it's a contractual right. If you buy a bond, maybe it will be a corporate bond. If you buy a bond, it is giving you a contractual right to receive cash. Okay.
Yes.
That what is what we are referring to as a bond. So the bond market is important because it enables corporations and governments. There is also what is known as a government bond. There's also what is known as a corporate bond. Okay, so these are now the government and private corporations. They also use these instruments to raise finances. Okay, because if you buy a corporate bond, you are given that contractual right. It might be a bond, just look like a certificate, right, which gives you contractual right to be paid over time. Okay, so just like a certificate. So basically, what have happened is that if you have decided to buy a corporate bond or even a government bond, you are giving the government, or you are giving that firm money, right? You give them money. Maybe that bond, it has a face value of 30,000 rand. So basically, that firm or the government, you have raised 30,000 rand after you have decided to buy that bond. Okay, so this is another way in which corporations or government can raise finances. Okay.
Yes.
So we can also define a bond as a debt. So it is now a debt. Why are we saying it is a debt? Because the corporation or the firm or that government, it now owes you. If the government or that firm sells a bond, right, it means that it now owes you, and it's now a debt to them. Because at some point in time, that bond will mature, right? It will have a maturity period. Maybe it matures after 10 years. After 10 years, it also means that you are going to get your principal, That is the amount that the amount of the bond when you bought it, and then also interest above that. Okay. So it also means that it is a debt to the corporate or to the government. That's why we are saying that a bond is a debt that promises to make payments periodically. Okay. Periodically just means maybe yearly. You have a bond which matures in 10 years, but yearly you'll be receiving this kind of amount, which will be stated in that bond. Okay. So a bond is a debt that promises to make payments periodically for a specific period of time. A bond can also be defined as an instrument of indebtedness of the bond issuer to the holders. Okay, so there's a bond issuer and then there's a holder. So that corporate or the government will be now the bond issuer. Okay, and it is a form of debt. Okay, so the most common types of bonds include municipal bonds. So municipal bonds is also a type of government bond, because a municipality is a what? Is a local government, right?
Yes.
Local government. It is a form of government, actually. Okay. So there are types of bonds which include municipal bonds and corporate bonds. Bonds can be in mutual funds or can be in private investing, where a person would give a bond to a company or a government. Okay. So basically, we now know what a bond is all about. We say that a bond.
Can I just ask?
Yes.
Sorry, can I just ask something? What do municipal bonds finance?
Municipal bonds.
Yeah.
Okay. A municipal. Come again.
Yeah, if let's say it's a type of government bond, then what's it used for? Because usually we talk about the government bond, but then not so much on the types of bonds of government bonds.
Okay. So here now, with regard to municipal bonds, we are saying that local authorities, just like municipalities, right? They may at times be in need of some finances, okay? And in that way, they may issue what are known as municipal bonds, just like a municipality, just like a local authority, okay? So that's why we are saying that this is included in what is known as a government bond, okay? Because it is a form of government. A local authority is a form of government, only that it is different from the government as a whole, because it only deals with a specific geographical area and the like, just like what a municipalities does, just like what local authorities does. So we are saying that at some point in time, this local authority might be in need of finances. Maybe it wants to fund its activities and the like, okay? It wants to maybe to build a bridge in that area in which it is responsible of. It maybe want to reconstruct the road, okay? So in that way, it can issue what is known as a municipal bonds. And basically, municipal bonds, it have low risk compared to a corporate bond, okay? Because we know that at some point in time, the government cannot be said to have run illiquid, okay?
Okay.
So it may issue what are known as municipal bonds. And municipal bonds, they are risk-free. Basically, they also do not have high interest rate compared to a corporate bond. Okay. So that's how a municipal bond works. It's just a local authority which have decided to raise some finances through issuing what are known as municipal bonds. That's why we also say that we have what are known as corporate bond and government bond. So this one is just included in government bond, okay? It can also be known as a government bond, but it's only that it is issued by a local authority or a municipality.
Okay. Thank you very much.
Okay, you're welcome.
I get it.
Okay, so let's take into account. So we said that this subtopic is about the bond market. and interest rates. So we also need to take into account what do we mean by interest rates. Okay, so basically interest rates is taken into account by two perspectives. Okay, if we define interest rates, we define it with two perspectives. Okay, we have one perspective of a borrower. We also have one perspective of a saver. Okay, we have one perspective of a borrower. So it works differently. The same interest rate, if we say interest rate of 7%, it works differently to a borrower and to a saver, but it is the same interest rate. Okay, so what do we mean now? We mean that interest rate, we can simply define it as the cost of borrowing, okay, and the benefit of saving. Okay, if you want to borrow, if you borrow maybe 10,000 rand, and then you are charged 7% interest, it means that interest in your perspective is a cost. Okay, because at the end of the day, you have to return the principal of 10,000, and then you add the interest that you were charged. So in that manner, it becomes a cost. It becomes a cost of borrowing. Okay.
Yes.
But now, if you are now a saver now, right? You have decided to say, no, let me save 10,000 and also earn 7% interest. That means that interest rate is now a benefit, because at the end of the day, that interest is going to be added on top of your savings. Okay.
Yeah.
That's why we said we have two perspectives. One, the perspective of a borrower, and the second is the perspective of a saver. So to a borrower, it's a cost, and then to a saver, it's a benefit. Okay.
Yeah.
So interest rates are important. Why are we taking into account interest rates? One, higher interest rates could deter one from borrowing. Okay, higher interest rates, of course, it now means that higher interest rate, it is synonymous to a higher cost. Okay, so at the end of the day, it will deter you from borrowing. You will no longer want to borrow because the interest rate is very high. Okay. Two,
Yes.
conversely, the other way around, higher interest rates could encourage one to save money as cost of borrowing is high. So we are now saying that to the perspective of a saver now, it can encourage you to save. Okay. By saving, it now means that at the end of the day, you are no longer consuming those finances. You are now saving them to earn an interest. Okay. They impact the general health of an economy. So at the end of the day, these interest rates, they impact the general health of an economy as they affect consumers and businesses' willingness to spend. How do they affect consumers and businesses' willingness to save, to spend? Okay, we are saying that high interest rates, okay, let's say FNB approaches you, and then they can give you a call and say, no, if you save with us for this time period, if you save 1,000 rand, within 3 months' time, you earn maybe on top of your 1,000 rand, you earn 700 rand. Okay. That is attractive, ne?
Yes.
That is attractive. Only saving your money in your bank. You did not start any new business. You just place your money in a bank, and then they'll say in 3 months' time, you earn 70% interest on top. So that means that the 1,000 you have decided to save, you also decided not to spend it. Okay. You also decided not to spend it. So what is happening? It has affected your willingness to spend. And we know that the economy grows as much as we spend, okay? Because as much as we spend, that is the more as the economy produces. Just like any example you might think of. Let's say you have a confectionery shop, okay? You have a confectionery shop, and then in the morning you are seeing that the people that your customers, they are queuing outside. What do? Of course, you are motivated to produce more, right? But if you spend less, you're also demotivated to spend more. So that's how interest rates affect the levels of expenditure, okay?
Yes.
So that is in terms of consumers. It can also be in terms of businesses. It can also be in terms of firms. Firms, they do invest. So expenditure through firms is known as investment. Expenditure through customers is known as consumption expenditure. By firms, it is known as investment expenditure. So for firms to invest, they also take into account interest rates. Why do they take into account interest rates? For firms to invest, they also need to borrow, okay? So when the interest rate is very high, that also means that the cost of borrowing is also high, okay? If the cost of borrowing is also high, it will also deter investment expenditure. So that's simply how it works. It's very simple, né?
Yeah.
And I think you did that in ECS 26, or did you do ECS 2602?
With no.
You didn't
I
do
did 05.
05. Oh,
Yeah.
that was your first one for economics. How about the likes of 1601, 1501, and the like?
No, I'm from another institution, so I did it with that institution. So, but then I got a transfer.
Oh, okay. You were not at UNISA.
No.
Okay, that's fine. So this one is one of an interesting module actually, ECS3701. It's very interesting, as you can see. Most of the concept, they are very practical. So that's why I mostly give practical examples, okay? So that you can see things practically than within the perspective of a book, okay? So we did take into account the bond market. We now need to take into account the stock market, okay? We now need to take into account the stock market. Okay, so a common stock represents a share of ownership. Okay, so now you can determine the difference, right, between a bond and a stock. Now we are referring to a share of ownership. Okay, so if you own a stock, it also means that you are part of that firm. If you own a stock with ABSA, it also means that you have some form of ownership with ABSA, okay?
Yes.
So, okay, how do I remove this thing? Okay, so a common stock represents a share of ownership in a corporation. It is a security claim on the earnings and assets of a corporation. Issuing stocks and selling it to the public is also a way in which a firm can raise its funds, okay? It is also a way, just like issuing a bond, okay? So the stock market is important as the price of the shares affects the amount of funds that can be raised. Okay.
Yes.
By selling newly issued stock to finance spending, a higher price means more funds. Okay, so we are also saying that when a firm decides to raise its funds through issuing of stocks, the price of shares, it does also affect the amount of funds that can be raised. Okay, if it is very expensive, at the end of the day, you might not be able to raise enough funds. Okay, if it's very expensive, at the end of the day, you might not be able to raise enough funds. That is with regard to the stock market. Okay, so what is also included in the first chapter? Why study financial institutions and banking? Why study financial institutions and banking? So banks and other financial institutions are what makes financial markets work. Okay, so basically within the financial institutions, we are saying that the banks and many other financial institutions, which might include mutual funds, which might include finance companies, investment banks, and the like. Okay, without them, financial markets would not be able to move funds from people who save to people who have productive investment opportunities. Okay, just like what we discussed earlier on, when we said that these financial institutions, they stand in between people who save and those who want to borrow. Okay, so the financial system is complex, comprising many different types. Private sector financial institutions, they include the banks, insurance companies, mutual funds, finance companies, investment banks, which are also taken into account them separately, all of which are heavily regulated by the government. Okay, so the government is supreme within the financial institution, and usually it is the South African Reserve Bank that governs the financial institutions. Okay, so every policies that the South African Reserve Bank takes into account, it also has the responsibility of keeping the financial markets as healthy as possible. Okay.
Yes.
So what is a financial crisis? Of course, you know a financial crisis, né?
Mm-hmm.
Financial crisis. What do you think a financial crisis is?
I think it's
you are not
like
reading
I said,
on my
collapse in the financial market.
Mm-hmm.
That it disrupts the functionality
Mm-hmm.
of the whole financial system.
Of the whole financial system, exactly. 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 So a financial crisis is a major disruption in the financial market that are characterized, it is characterized by sharp declines in asset prices and failure of many financial and non-financial firms. Okay.
Yes.
So there was a major, a financial crisis happened in 2008. There was a global financial crisis in 2008. I'm not sure if you are familiar with that one. And
No.
I don't think South Africa was much affected actually by the global financial crisis. But I think if you remember well, many in many African countries, there were bank closure. Much of the financial system was disrupted a lot. Okay.
Mm-hmm.
Was disrupted. So that is what we mean by financial crisis. It is a disruption in the financial market, and it is characterized by a decline in asset prices and failure of many financial and non-financial firms. Okay.
Yes. Can I just ask, what do you mean when you say South Africa wasn't affected that much? Because when it happened in 2008,
Yes.
the prices of like borrowing, let's say for house,
Mm-hmm.
what do you call it? You know, like when you want to buy property, when you want to buy a house, it's
Mm-hmm.
like the prices were high.
Were very high.
Or let me say the interest rate was high.
Okay. Okay. On that, I meant that maybe the effect was not that much. Maybe the effect was not that much. Did many financial firms close, or any banks that you knew before, which closed afterwards? Maybe in 2008.
Oh, okay.
So I think maybe the effect wasn't that much compared to other African countries, just like Zimbabwe. I think in Zimbabwe, if I remember well, more than 18 banks closed, and that is a huge effect, ne? That is a huge
Out
effect.
of how many?
Mostly the banks that are still. I'm not really remembering the numbers, but I remember more than 18. Most of them which did survive were government-owned banks.
Yeah.
And mostly the other one, I think, which survived was Standard Chartered, and Standard Chartered is an international bank, actually. So most of them which were domestically owned, they did close.
Yeah.
They did close. So the effect was very much compared to South Africa. Okay, so I'm seeing that on my account there's 2 minutes which is left now, and this account haven't been paid already because most classes haven't started. So basically, if it goes off, you can just use the same link to join the class. Okay.
Okay.
Okay, so let's also take into account financial innovation. Financial innovation. So financial innovation is basically defined as the process of creating new financial or investment products, services, or processes. So basically, when we give reference to financial innovation, we are saying that the technology usually that is implemented within the financial system is that what we refer to as financial innovation. Just like an e-wallet, it's a form of financial innovation. Just like a cash send, it's a form of a financial innovation. Just like mobile money, it is also an example of financial innovation. Okay.
Yes.
So these changes can include, yes, updated technology, risk management, risk transfer, credit and equity generation, as well as many other innovations that you might think of. Okay. So that is what is included in financial innovation. It's just a progress in terms of the financial system, how the system works. It's a technological advancement, okay? Just like that tap and go, if you use, is it Capitec, or I think it's Capitec which uses that one. There's no need for you to place a pin, you just tap. Is it Capitec or apps? I'm not, but I think somewhere between those two, just tap. It's also an example of what? Of financial innovation. Eh? Okay.